If you know how to spot the right entry points in your trades, you can easily achieve results like this, this, and this. I'm David, CEO at EA Automatic, and today I'm going to share the secrets to finding those perfect entry points. I'll walk you through the concept of smart money, the very strategy that I and other professional traders use to identify moves before everyone else does. It's the same strategy that brought me $6,000 just a few days ago, and you will be able to apply this strategy immediately after watching this video. So watch to the end. You may already know that we have a closed trading community. Our members use smart money and many other strategies, but also they use one thing that gives them the ultimate edge over the market. They do it hands-free with EA Automatic, a tool that automates trading with AI-enhanced algorithms. Last month alone, I made over $55,000 of passive income with this trading tool by targeting entry points faster than any human can react and executing trades with precision that manual trading simply can't match. The future of trading is here, and you can try it for free. Just follow the link in the description to our Telegram channel. Send us a message with the word robot, and we'll connect you to the system the same day. Start automating your trading and building passive income today. Follow the link in the description. We'd love to have you with us. All right, the smart money strategy. The concept starts with the idea that our market structure is defined by specific characteristics. We see an uptrend, visually clear as prices continuously make new highs, and a downtrend, where prices consistently drop to new lows. In real time, as soon as a new high is reached, we recognize an uptrend. Similarly, when a new low is hit, we acknowledge that a downtrend is in play. Essentially, while the market is trending upwards, we look for opportunities to buy, and during a downtrend, we seek opportunities to sell. This approach has always been clear and proven over time. Remember, the trend is your friend. Now you might wonder how to determine when a trend changes or when market structure breaks according to the smart money concept. The answer lies in observing the latest lows or highs. For instance, during an uptrend, if the most recent low is broken, as you can see here, it signals a change in the movement's character. Following that, the price makes a new low, indicating that a downward trend or bearish trend is starting. On the flip side, during a downtrend, if the last high is broken and the price moves upward, we interpret that as a reversal from downtrend to uptrend. This is what sets the criteria for the new trend. Understanding this, we know that an uptrend is maintained by new highs while the lows remain intact until that critical low is finally broken. The same applies to a downtrend, where the new lows continue to form while the highs hold. As soon as the high related to the last low is updated, it clearly shows that the market's character has shifted. To bring this concept to life, let's consider a chart example. We observe an upward move where the last high is reached and the momentum continues upward, even though the lows haven't changed. Then, once a new low is established, the structure breaks and a downtrend begins. Often, you might see an upward move following a break until that last low is eventually broken again. In essence, as soon as the character of the movement shifts, we adjust our strategy by looking for buy or sell signals. This interplay is a key element of the smart money approach. Moving on, another important component of the smart money concept is the fair value gap, or FVG. Imagine a situation where a sharp, impulsive move occurs. Often, the next candle does not have enough time to completely cover the previous candle's high, creating what we call a fair value gap. So what does that look like on the chart? Picture a scenario where there was a corrective movement with prices closely aligned, and then suddenly a strong impulse occurs. The first candle sets a high, followed by an even stronger move in the next few candles. As the move continues, a fair value gap appears. Typically, the price will return to fill this gap because it represents a zone where large players have placed their orders and where liquidity is available. In other words, noticing these fair value gaps can help us decide when to enter the market, whether we are looking to buy or sell. The idea is that the market tends to correct itself by filling these gaps, and that predictable behavior becomes a reliable signal. To further illustrate, let's look at a real example. Suppose the price reached a certain level, removed liquidity, and then began moving downward. In that area, you might see several fair value gaps. In one instance, a small gap gets entirely filled, and later, a larger gap is also completely covered by the price action. Even after an upward move, the price might return to fill these gaps. This behavior means that if you miss an entry for the first time, there might be another opportunity when the gap is filled. In another case, you could observe a gap forming and then being targeted by the price. Once we understand that the price tends to return to fill a fair value gap after an impulse, we can incorporate this behavior into our trading strategy. Next, let's talk about another key element: order blocks and breaker blocks. These elements become evident during corrective moves when the last candle bar in that move changes direction. This shift creates an order block, which can either be bearish or bullish depending on how the market reverses. For example, imagine a scenario where a low is reached and then broken, followed up by an upward impulse. Just before this impulse, we identify the last bearish reverse candle. We extend that range to the right, and that area becomes our order block. This is where large players have accumulated positions in anticipation of the upward move. Essentially, large capital often positions itself against the expected movement, and once the price moves upward and later revisits this area, we can drop down a few time frames, say from D1 to H1 or M15, to confirm our entry. Likewise, consider an order block for selling. After a downward move, a bearish order block might form where the last bullish candle signals a potential reversal. When the price comes back to this area, we can refine our entry on a lower time frame, like M5, and then enter a sell position. If confirmed, that area becomes a strong signal for a bearish move. Sometimes you might notice that after breaking a specific level, the market forms what we call a breaker block. For instance, if there's a strong move and a structure break occurs after testing a particular area, the previously defined order block may turn into a breaker block. When the price returns to test this breaker block, it offers another potential entry for a sell trade. This additional layer of analysis further refines our entry points using the smart money concept. Finally, all these elements, FVG, order blocks, and higher time frame breaker blocks, come together to form what we call the point of interest, POI. The POI is essentially the area where we drop down to lower time frames to make our final trading decisions. In this context, using these elements helps us fine-tune our entries on lower time frames. To further filter which signals are valid, we also use Fibonacci retracement levels. We observe an impulse move, all chart elements that fall above the equilibrium area, around 50% of retracement level, become more reliable. Levels such as 0.62, 0.705, and 0.79 are considered optimal trading entry zones. For instance, if a FVG or order block is above the 50% level, it is generally a stronger signal for selling. Conversely, when looking to buy, we pay attention to elements below the 50% level, which might include FVGs that haven't been fully covered or order blocks that serve as key decision areas. In short, our primary focus is always recognizing when the market structure breaks down. Once a structural break is observed, we look for the optimal trade entry area. In our example, this FVG entry is located above the equilibrium zone, where we might find elements like FVG or a breaker block that help us pinpoint our entry. If the price moves into this zone and our entry is confirmed, we take the position. If not, we stay on the sidelines. By integrating elements such as market structure breaks, trading in the direction of the trend, using Fibonacci to find the best trade entry, and refining entry points on lower timeframes with the help of POI, we maximize our chances of successful trades. Now, let's see how to find entries to your trades in practice. Before we continue, take a moment to click the link in the description and join our free Telegram community. It's a great way to dive deeper into the world of automated trading and stay on top of new ideas and tools. Okay, let's break down a few entries using this strategy and identify which elements we focus on first. As you can see, we already have a downward move, signs of a structural break, and then an upward move. From here, we'll observe how the situation unfolds since the price has already reached previous zones. I use Fibonacci because it helps me identify potential future price levels and where I should look for entry points to continue the move. In this case, upward. Around the 50% level, or what we call the equilibrium zone, several elements come into play. For example, here we notice some liquidity and an order block. One of the order blocks aligns exactly with the 0.62 level. So as soon as the price nears that area, I start looking for entry points on the M15 timeframe. Now, take a look at what happened next. The price made a downward move, swept away that liquidity, and entered what we refer to as the POI area, the point of interest. At this point, I switch over to the M15 chart where we need to see a clear structural break before entering a trade. I plan to place my stop loss order just below the low of that price action. So, what happened? Notice that the last high was broken, indicating that a structural break took place. This gives us the opportunity to refine our entry and step in right there within the entry zone. Here, within our entry zone, we set up our stop loss order just below the recent low, with a little extra buffer for safety. The nearest levels that price might reach are the liquidity zones it left behind earlier. In this example, there are two such areas where the price left liquidity, and these serve as our targets for take profit. The risk-reward ratio here is around 1:4, which is quite favorable. Let's see what happens next. The price triggered our limit order, continued its move, and we eventually reached our take profit. Admittedly, it took a bit longer. Sure, we could have exited at the nearest liquidity level for about a 1:2.5 ratio, but holding out for 1:4 risk-reward was more appealing since it offered significantly larger profit. Now we switch back to the H4 timeframe. Here, we continue watching the price action chart. The upward move is still in progress. We have marked the fair value gap, the FVG, drawn our Fibonacci levels, and identified the optimal trade entry zone from 0.5 to 0.79. Now we watch how the price action unfolds. At this point, liquidity is being taken out. We see another liquidity zone forming as the price approaches this area. We switch to a lower time frame to check what's happening on the M15 chart. As you can see, the downward move continues. So far, we notice that the low is changing. It's updating, while the high remains unchanged. So we keep observing. The price has entered our liquidity zone. Let's continue watching. Liquidity has been taken out. Notice what happened? A slight touch on the FVG area and the additional liquidity was swept from that zone. Now, a structural break has appeared right here. This is our signal to open a long position in the FVG area. We set our entry just above the minimum. You might go a little bit lower for extra safety, but this area works well. Next, we determine our take profit levels. There are several targets. The nearest liquidity level is for those who want to exit quickly, and there's a second, more distant zone as well. For the H4 time frame, the optimal target is this maximum, and I generally expect the price to move more toward that maximum, giving us a risk-reward ratio of about 1:5. Let's see how the price performs. We took profit at the first level, right at the nearest liquidity zone. Then the price reached the second take profit area and even touched the third, where we took additional profit. In total, we achieved a take profit ratio of approximately 1 to 5.44, which is a very good result. And then we closed the trade. In short, we captured the move at one point and then again further along. And that's how we execute our trades. Key elements that guide our decision-making include the FVGs, as seen here, with a structural break and a small FVG triggering our long entry. Fibonacci levels also help, and sometimes order blocks on higher timeframes provide a clearer picture. For example, in this case, an order block formed, a structural break occurred, the price retraced, and we entered the trade. These kinds of trades happen regularly. It all depends on the time frame you choose. If you're trading on M15, you'll see more setups. If you're using H1 or H4, there will be fewer. Now that you've got a solid understanding of how to spot those key entry points, let's take a moment to consider the bigger picture. While this all sounds great, the reality is monitoring charts, analyzing trends, and managing entries can be time-consuming and stressful. It requires constant focus and precision, and that can lead to burnout or missed opportunities. So why deal with all that when you can let a smart robot handle the heavy work, constantly evolving to make smarter decisions for you? With automated solutions like EA Automatic, you don't have to spend all day staring at the screen. We've built our own AI system to power all the bots. It learns and improves daily, using historical data and strategies from top traders, combining them with key indicators to make accurate trades and manage risk the right way. Now, if all this sounds a bit new to you, don't worry, we're offering a free trial with a personal trader to guide you through it. This way, you can see firsthand how smoothly it all works and how much it can actually improve your trading. And hey, you've probably heard that by 2030, AI will be taking over 30% of jobs. So why not start using it now to gain an edge in your trading? The secret is now is the perfect time to get your AI trading edge. The sooner you begin, the greater your results will be, especially with the power of compounding, which we covered in one of our earlier videos. Follow the link in the description and get in touch with us today, and we'll have everything set up for you the very same day. You'll be able to access a whole new level of trading, free from the emotional ups and downs that often get in the way. With calm, calculated decisions, discipline, and consistent results, you'll see how much more effective trading can be. So click the link in the description, send us a message, and let's get started. We'd be happy to have you on board.